If you're trying to understand what just happened in silver by staring at the percentage drop alone, you're already looking in the wrong place. Big numbers on a screen are emotionally loud, but they're not always informational. What matters is why the move happened, who was forced to act, and what the physical market did while the paper market was unraveling. Because here's the uncomfortable truth most people don't like to hear. Violent crashes in commodities are rarely about value changing overnight. They're about positioning collapsing. They're about leverage meeting rules. They're about systems doing exactly what they were designed to do when stress exceeds tolerance. Silver didn't suddenly become less useful to the global economy in a single day. Solar panels didn't stop needing it. Electronics didn't redesign themselves. Refiners didn't discover a magical replacement. What changed was the ability of certain participants to remain in leveraged paper positions once volatility crossed a threshold. That distinction matters because it separates structural reality from temporary price behavior. Modern commodity markets are layered. At the top, you have futures, options, ETFs, and synthetic exposure, instruments that trade quickly and react instantly to margin, volatility, and risk controls. Beneath that, you have physical metal moving through supply chains, refineries, manufacturers, and regional distribution networks that do not respond at the speed of a margin call. When stress hits, those layers don't move together. The paper layer can collapse while the physical layer tightens. And that's exactly the type of move that confuses people. When prices fall hard, the instinctive reaction is to assume demand has vanished. But demand doesn't vanish in a day. What vanishes is tolerance for leverage. Once price drops far enough, forced selling takes over. Positions are closed not because someone changed their mind, but because they no longer had a choice. The market doesn't ask permission when collateral rules are triggered. This is why these moves feel nonlinear. One minute things look stable, the next minute everything is sliding. It's not because information suddenly changed, it's because thresholds were crossed. And once that happens, price discovery is no longer a calm debate. It's an auction under duress. Silver is particularly exposed to this dynamic because it sits in a narrow channel between financial speculation and industrial necessity. It's liquid enough to attract leverage, but constrained enough physically that the leverage can become dangerous when conditions tighten. That combination produces spectacular volatility when the system is stressed. The key signal that this was not a normal, everyone lost interest sell-off is what happened outside the paper market. In a true demand collapse, physical premiums compress. Buyers disappear. Sellers undercut each other just to move inventory. That's not what you see here. What you see instead is physical metal commanding a materially higher price in regions where supply matters most. That divergence is not a curiosity, it's a warning. It tells you that while futures traders were being liquidated, physical buyers were stepping in. Not because they love volatility, but because they understand availability risk. For a manufacturer or a supply chain manager, price volatility is inconvenient. A lack of supply is existential. If you can't get the input, the line stops. And when that's the choice, paying a premium becomes rational. This is why regional price differences matter more than global headlines. A market where one region pays significantly more for the same metal is a market where price is no longer unified. And when price fragments, the reference price on a screen becomes less authoritative. People often dismiss this by saying arbitrage will fix it. Sometimes it does, sometimes it can't, at least not quickly. Logistics, regulations, delivery timelines, and inventory availability all slow arbitrage down. In the meantime, the divergence reflects real stress, not speculation. Now, add ratios into the mix, and the picture becomes clearer. When gold holds up better than silver during a liquidation event, it doesn't mean silver is broken. It means liquidity preference kicked in. Gold is deeper, more institutional, and more easily financed. Silver, being thinner and more industrial, absorbs pressure more violently on the way down and often rebounds more aggressively once the forced selling ends. This pattern repeats because it's structural, not emotional. What makes moments like this dangerous is the temptation to draw simple conclusions. It crashed, so the story is over. Or the opposite. It crashed, so it must immediately reverse. Both miss the point. The market is in transition. It's moving from a leverage-dominated phase to a reality-dominated phase. That transition is messy. Short-term technical damage is real. Levels break. Momentum flips. Risk assets sell off together when liquidity tightens. Ignoring that is reckless. But ignoring the physical signals because price is falling is just as reckless. The art is understanding that both can be true at once. This is also where broader macro conditions matter. When multiple asset classes are under pressure, metals don't get a free pass just because they're hard assets. In the early stages of de-risking, everything that can be sold often is sold. Safe haven behavior tends to appear later, after forced selling has run its course and capital starts looking for protection again. That sequence trips people up because it contradicts the narrative they want. They expect metals to rise immediately during stress. Sometimes they do, often they don't. Timing matters, sequence matters. And then there's policy uncertainty layered on top, which acts like gasoline on volatility. When markets are anticipating a major monetary signal, they become hypersensitive. Liquidity thins. Positioning becomes defensive. Any excuse becomes a trigger. This doesn't mean the policy outcome will match the fear or hope priced in. It means the market is unstable heading into the event. In those environments, price can overshoot in both directions. It can fall below where willing buyers exist, and then snap back violently once selling pressure exhausts. or it can grind lower if macro conditions keep tightening. The point is not to predict the headline. The point is to recognize fragility. Fragile markets punish certainty. They reward flexibility. So the real question you should be asking right now is not, is silver cheap or expensive? It's, what kind of market is this? Is it a market clearing through opinion or a market clearing through force? Is it dominated by discretionary selling or by rules-based liquidation? Is the physical layer confirming the paper signal or rejecting it? Those answers determine behavior. If you're leveraged, this is not an environment that forgives mistakes. Volatility doesn't negotiate. If you're positioned structurally, you still have to accept that price can move against you in the short term without invalidating the long-term imbalance. Both truths coexist, and pretending otherwise is how people get hurt. Silver right now is not sending a single clean message. It's sending two messages at once. One from the paper market screaming stress, one from the physical market signaling scarcity. Those messages will eventually reconcile. They always do. The only unknown is which side moves and how violently when the reconciliation happens. That's the setup. Not a guarantee, not a prediction, a setup. And understanding the setup is more valuable than arguing about today's candle. The reason setups like this make people uncomfortable is because they force you to hold two ideas at the same time, and most people are wired to want only one. The first idea is that price action can be legitimately bearish in the short term. The second is that the underlying market can be tightening at the same time. Those ideas are not mutually exclusive, but they feel like they should be, so people reject one of them to regain emotional clarity. Markets don't care about emotional clarity. They care about clearing imbalances. When leverage builds on top of a thin physical base, the unwind is rarely elegant. It doesn't wait for consensus. It doesn't wait for confirmation. It happens when rules collide with reality. That's why the most violent moves tend to come when people are still arguing about whether anything is wrong. By the time the argument is settled, the damage is already done. This is also why focusing on villains or manipulation misses the real lesson. Markets don't need conspiracies to behave brutally. They only need incentives, leverage, and constraints. If a large portion of positioning depends on price not moving too far too fast, then a fast move will expose that fragility. No coordination required. The system does the work. In silver, the system is particularly sensitive because supply does not flex easily. Mining output doesn't surge just because price spiked last week. Refining capacity doesn't expand on command. Recycling responds slowly. That means supply elasticity is low. When demand is steady or rising and supply can't respond, the only variable left to absorb stress is price. And when price is burned with leverage, that absorption becomes chaotic. What happens next is not determined by who is loudest online. It's determined by exhaustion. At some point, the forced sellers finish selling. The marginal seller disappears. The market stops cascading and starts reacting. That transition is subtle. It doesn't come with a headline. It shows up as a change in behavior. Dips stop accelerating. Rallies stop being instantly faded. Liquidity improves slightly instead of vanishing. This is where many people get caught offside, because they expect resolution to look dramatic. In reality, it often starts quietly. The market stops punishing patience. It starts punishing impulsiveness instead. At the same time, the physical market keeps doing what it does. Buyers who need metal continue to secure supply. Premiums remain elevated because access still matters. Inventory flows continue to reflect demand that isn't going away just because futures had a bad week. That slow, persistent behavior is easy to ignore when screens are flashing red, but it's often the anchor that pulls price back toward reality once the paper storm passes. This is also why the idea of fair value becomes slippery in these environments. Fair value assumes smooth markets, rational actors, and balanced flows. None of those assumptions hold during liquidation events. Price temporarily loses its role as an equilibrium signal and becomes a stress valve. It moves until pressure is relieved, not until value is agreed upon. Understanding that distinction can save you from making decisions you'll regret. Chasing the move because it feels obvious is often how people end up buying tops or shorting lows. Doing nothing when the market is incoherent is sometimes the most rational choice, even if it feels unsatisfying. Another trap to avoid is assuming that because silver is volatile, it must be unreliable. Volatility is not unreliability, it's sensitivity. Silver reacts more violently because it sits closer to the fault line between finance and industry. That makes it uncomfortable to hold, but it also makes it informative. It shows stress earlier and more aggressively than assets that are buffered by deeper liquidity. Over longer horizons, that sensitivity is often what allows silver to outperform when conditions favor it. But getting from here to there is rarely comfortable. The path runs through shakeouts, false breaks, and moments where conviction is tested. Anyone who tells you otherwise is selling comfort, not insight. The macro backdrop adds another layer of complexity. When monetary policy credibility is questioned, hard assets eventually benefit, but eventually is not immediately. The market often needs to flush leverage first, reprice risk, and re-anchor expectations before it starts rewarding defensive positioning. That lag is where most people lose patience. Patience, however, doesn't mean stubbornness. It means aligning exposure with risk tolerance. It means not using leverage in environments designed to destroy it. It means acknowledging that being early feels exactly like being wrong until it doesn't. Silver right now is testing that distinction. It's testing whether participants understand the difference between a paper flush and a physical unwind. It's testing whether people can hold a thesis without forcing it to validate itself on their timeline. Eventually, the divergence resolves. Either physical demand weakens enough that premiums collapse and inventories rebuild, or the paper market is forced to reprice as maintaining artificial suppression becomes too costly. History suggests that when physical markets refuse to confirm paper weakness for long periods, the resolution tends to favor the physical side. But timing that resolution is not the same as understanding it. So instead of asking whether today's price is real or fake, ask a better question. Ask which risks matter most to you. Is it mark-to-market volatility or availability? Is it short-term drawdown or long-term purchasing power? Those answers determine how this market fits into your life, not the other way around. There's no obligation to act. There's no rule that says you must trade every dramatic move. The market will still be here tomorrow. What matters is that when you do act, you're doing so with awareness of the environment you're stepping into. Right now, that environment is defined by stress, divergence, and transition. Paper prices are unstable. Physical signals are firm. Leverage is being purged. Policy uncertainty is amplifying noise. Those are not conditions that reward bravado. They reward discipline. Silver is not broken. It's not resolved either. It's in the middle of a process. And processes don't end because people are tired of watching them. They end when the system has adjusted enough to function again. If you understand that, you don't need certainty to operate. You just need respect for risk, clarity about intent, and the humility to let the market finish what it started before you decide what comes next.